Hello everyone, this is Orhan. In this video, I'm going to talk about Chapter 1 of Brigham and Houston's Financial Management book. This chapter will give you an idea of what financial management is all about. In this chapter, I will give you an introduction and definition of finance and discuss different forms of business organizations. This picture shows us a certificate of debt from 19th century BC. As you can see, financial instruments, they are more than 40 centuries old. So as a science, mathematics and physics, they are thousands of years old too. Even though financial instruments, they are old, finance as a science, it's not very old. It's a couple of hundred years old. It's from around 18th century. Let's discuss what finance is and what is it for. Finance is the study of how money is managed and the process of acquiring funds for new activities. Even though, as I said, finance is not as old, so it's financial instruments and financial markets, they are old. As a discipline, finance is not that old. So that's why the theories, ideas, and insights, they are still subject to criticism. Let's talk about three main areas of finance. The first one is financial management, which mainly focuses on decisions relating to how much and what types of assets to acquire and how to raise the capital needed to purchase assets. It's mainly about firms. Capital markets, they relate to markets where interest rates along with stock and bond prices are determined. The third one, investments, relate to decisions concerning stocks and bonds and include a number of activities like security analysis, portfolio theory, and market analysis. Most businesses and not-for-profit organizations have an organization chart similar to the one shown on your screen right now. The board of the directors is the top governing body, and the chairperson of the board is generally the highest ranking individual. The chief executive officer, CEO, comes next. The chief financial officer, CFO, who is generally a senior vice president and third ranking officer, is in charge of accounting, finance, credit policy, and decisions regarding to asset acquisitions, mergers, etc. Now let's talk about different forms of business organizations. The first one is called proprietorship. It is an unincorporated business owned by one individual only. Everything is that person, meaning like taxes, investments, decisions, control, everything is managed by the owner. And the partnership is similar. The second one is partnership. eBay, once upon a time, was formed as a proprietorship. It's not anymore. Partnership is the similar thing, a similar organization with two or more people. The question is, what are the characteristics of partnership and proprietorship? So let's talk about advantages and disadvantages of the first two organizations. The first one is proprietorship once again. Second one is partnership. The advantages, it's very easy to form this kind of organization. It's very inexpensive. They are subject to very few government regulations, and they are subject to lower income tax than our corporations, which are the third form I will mention in a moment. So what are the disadvantages? Disadvantages are, it is very difficult to raise capital, just because it might be a no-name person, so nobody would know you. And the second one is unlimited liability. People can use more than the amount of money they invested in the company. Meaning you might have invested $10,000 to start a business, but you might be sued for $1 million if during the company time one of your employees runs over someone with car or something similar. And the other one is the life of the business is limited to individual, meaning that if the owner dies, the company dies. Now let's talk about the third form of business organization, which is called a corporation. Corporation is a legal entity created by a state, and it's separate and distinct from its owners and managers. Harari, who is an historian and author of Sapiens, the book Sapiens, call corporations legal fictions, which are among humanity's most ingenious inventions, because during most of the recorded history, property could owned only by flesh and blood humans. But a corporation is a concept of our collective imagination. It does not exist eternally or independently of human society. If, for example, in 13th century, some person called Jean, this is Harari's example, by the way, set up a vegan manufacturing store, and the vegan he made broke down a week after the purchase, the buyer would have sued Jean personally. Everything Jean has might be subject to danger of capture. If he couldn't cover the debt, for example, he could be thrown in prison by the state and enslaved by his creditors. He was fully liable without limit for all obligations incurred by his store. This is why, Harari says, people began collectively to imagine the existence of limited liability companies. Such companies were legally independent of the people who set them up or invested money in them or managed them. Over the last few centuries, such companies have become the main players in the economic arena, and we have grown so used to them that we forget that they exist only in our imagination. So what are the advantages and disadvantages of corporations? Corporations are limited liability companies. This is the advantage. And their drawbacks is they are double taxed. Most corporations' earnings are subject to double taxation, meaning that the corporation's earnings are taxed, and then when it is after-tax earnings are paid out as dividends, those earnings are taxed again as personal income to tax holders. So as a remedy to this situation, as an aid to small businesses, Congress passed S corporations, which are taxed as if they were proprietorships or partnerships, thus they are exempt from corporate income tax. Now let's sum it up. So what are the advantages of corporations? They have unlimited life. So when the person who kind of founded the corporation dies, the company does not die. Like Steve Jobs died years ago, Apple still is here. It's very easy to transfer the ownership, and there's a limited liability, so you can't sue the company more than they invested. It's very easy to raise capital. These are advantages, and disadvantages are there's double taxation. So they have to report filing periodically. This is the disadvantage. So the question now is, what is the main financial goal of these corporations? In public corporations, managers and employees work on behalf of shareholders. So these shareholders are the owner of the business. Therefore, the managers, they have the obligation to pursue policies that promote stockholder value. Stockholders are the owners of the company, so managers work on behalf of them. But the question is, what is a value? How can we define the value? So managers, they have to promote the stockholder value, but the question is, how can we define value? Finance defines the value of any financial asset as the present value of all future cash flows. So I'm going to define in the coming chapters what present value is, but for the moment we can imagine if there's an expected cash flow in the future, the value of company is higher. If there's not, it's going to be lower. So the value of any financial assets, it is mainly based on the future cash flow. When we are talking about the value of any company, we should bear in mind the definition of these two concepts. The first one is actual value. The second one is intrinsic value. So actual value is in fact the price of the company. So whatever price you see on financial charts or Yahoo Finance, it's called actual value or price. It's the cash flows and risk that investors would expect if they had all the information about the company. But the question is, we do not always have all the available information about the company. That's why we should define the intrinsic value. Intrinsic value is in fact the must-be value of the stock price. So it's what investors expect. It's a long-term concept. So in this graph, the bold line, the green bold line shows the stock price. The dashed line shows the intrinsic value. So we should say that the intrinsic value cannot be observed like the price is. Nobody knows the intrinsic value. It's a concept. If we assume that there is something called intrinsic value which reflects the fundamentals of the company. For example, if the stock price is higher than the intrinsic value, which is here, which is the case here, the stock price is higher than the intrinsic value, we assume that stock is undervalued. Or for example, pay attention here, let's say between 1989 and 1990. So the stock price is lower than the dashed line. We assume that stock is undervalued. Undervalued meaning just go ahead and buy that stock. Well, there are a couple of theories, ideas about how to estimate the intrinsic value, but again, it's a concept and nobody knows it. So when they are equal, we assume there's an equilibrium called market equilibrium. As I said before, intrinsic value is a long-run concept, And let's note that management's goal should be to take actions designed to maximize the firm's intrinsic value, not its current market price. Just because maximizing the intrinsic value will maximize the average price over the long run, but not necessarily the current price at each point in time. For example, if you increase the investments, the stock price might go down, but in the long run, the company would benefit. Now let's talk about stockholder-manager conflicts. Let's ask this question. So who is supposed to take actions to maximize the firm's intrinsic value? It's managers. So let's remember, managers have the obligation to pursue policies that promote stockholder value. But do they always do that? The answer is no. So managers might be inclined to act in their own best interests, which are not always the same as the interest of stockholders. So there are a couple of tools that might motivate managerial behavior. Among others, the threat of firing, the threat of takeover, or compensation packages might be some examples. Compensation packages should be sufficient to attract and retain able managers, but they should not go beyond what is needed. Compensation policies need to be consistent over time, and also they should be structured so that the managers are rewarded on the basis of stock's performance over the long run, not the short run. The Wall Street Journal regularly evaluates the total compensation packages of large company CEOs. On your screen, you see this evaluation in 2019. As you can see, Alphabet CEO Pichai was paid the highest amount of compensation package, which is $280 million, while the shareholder return is 28% and median employee pay is approximately $260,000. Also, please note that the median pay reached $13.1 million for CEOs in 2019. So this graph kind of correlates the CEO pay and the shareholder returns. For example, Lisa Su's from Advanced Micro Devices payment is $58 million, while the return of her company is really incredibly high, so 148%. Now let's take a look at the 2020. So this is the 2020 graph. Chad Richardson from Paycom Software is paid $211 million, while in 2019 it was even lower. The other thing to note is the trend. So this graph will show us the trend. So the median pay for CEO of S&P 500 companies has been increasing in time. Managers should try to maximize their stock's intrinsic value and then communicate effectively with the stockholders. That will cause the intrinsic value to be high and the actual stock price to remain close to intrinsic value over time. But since the intrinsic value cannot be observed, it is almost impossible to know whether it is really being maximized or not. Let's try to wrap up the chapter. Let's remember that the manager's sole responsibility is to shareholders, because the shareholders are the owners of the company. So the managers are supposed to promote policies that will promote the company's value. So the question is, what is the value of the company? The finance defines the value of the company as the present value of all future cash flows. The manager's sole responsibility to increase the value of the company, which is mostly based on long-term policies. That's all about chapter 1. I hope you enjoyed the video and hope to see you in the second video, which is about the financial market.